I read a social media post this week with hundreds of likes. The title was, "Don't Miss the Roth Conversion Window." I did. What struck me here was the confusion in the comments. Hundreds of people were asking questions about their personal situations and hoping for impartial and reliable advice, which is why I decided to make this video. The mentioned window is real, and it's shorter than most people expect. And once a year passes, that year is gone permanently. There's no way to reclaim it from a tax standpoint. So today I want to walk through exactly what that window is, how to size a conversion inside it, and the 3 things that can quietly destroy the math if you ignore them. I'm going to use 2026 numbers throughout, and I will tell you which of those numbers change from year to year. So part 1, what the window actually is. Here's the situation that creates the opportunity. You retire in your early 60s, your paycheck stops, you haven't filed for Social Security yet because you're waiting for a larger benefit later, and required minimum distributions haven't started, because those begin at 73 if you were born between 1951 and 1959, or 75 if you were born in 1960 or later. For those years in between, your taxable income can be close to zero. Think about what that means. You spend the last 20 years of your career or so paying tax the highest rates you'll ever see. Then you enter a stretch where the bottom brackets are sitting completely empty. For most retirees, this stretch runs from 5 to 12 years into the lowest tax environment that they will ever experience for the rest of their lives. And a Roth conversion is how you can use that space. You move money from a traditional individual retirement account or an old employer plan into a Roth. You pay ordinary income tax on the amount you move, and from that point forward, the money grows tax-free, qualified withdrawals are tax-free, and there are no required minimum distributions on it during your lifetime. There's no annual limit on how much you can convert, and there's no income restrictions. And a conversion can't be undone once you make it, so the sizing decision deserves real consideration. For several years, the case for conversions leaned heavily on one argument. Tax rates were scheduled to rise at the end of 2025, so convert now and beat the increase. This was something that a lot of people called the tax sunset. That argument is over. The One Big Beautiful Bill, signed in July of 2025, made the current bracket structure permanent. 10, 12, 22, 24, 32, 35, and 37%. No sunset on the calendar. Some people took that news and concluded that the conversion conversation was finished, but that conclusion is wrong, and I want to explain why. Federal rates staying flat says nothing about your personal rate. Your personal rate is going to go up on its own schedule, driven by 3 forces. First, required minimum distributions. Your traditional account keeps compounding while you wait. A larger balance produces a larger forced withdrawal, and that withdrawal is stacked on top of everything else. Second, Social Security. Once benefits begin, they fill bracket space that used to be empty. And third, survivorship. When one spouse passes, the survivor files single. Single brackets are roughly half as wide at the same income levels. A widower can face a meaningfully higher rate on a similar amount of income. So the strategy is the same as it always was. Move money at a known lower rate today to avoid an unknown higher rate later. So how much should you actually convert? And this is the question everyone wants answered. And the honest answer here is that it depends entirely on your specific situation. But what I can give you is the framework advisors use to make that determination. You fill brackets from the bottom up. Start with the standard deduction. For a married couple filing jointly in 2026, that's $32,200. Both spouses are 65 or older, each adds another $1,650, bringing it to $35,500. That is income space that costs you nothing. Above the deduction, the 10% bracket runs to $24,800 of taxable income. The 12% bracket runs from there up to $100,800. Add the deduction to the top of that 12% bracket, and a married couple with no other income has roughly $133,000 of conversion capacity at a blended cost at about 10%. So let's think about that for a second. $133,000 moved into a tax-free account for a blended rate near 10%, in a year where that same money would otherwise be taxed at 22 or 24% when it comes out later. For single filers, the 10% bracket runs to the $12,400 and 12% runs to $50,400. Now, the 12% bracket is the comfortable answer, but it's frequently the wrong answer. If your traditional balance is still large enough that filling 12% every year still leaves you with enormous required minimum distributions at 73, then you could be better off filling the 22% bracket and sometimes the 24% bracket. For a married couple, 22% runs to $211,400 and the 24% runs to $403,550. The way to decide is to model the whole window every year from now until distributions begin and compare the total lifetime tax under each approach. 1 year at a time can be misleading. All right, let's move on to the Medicare cliff. Here's the first thing that can quietly break the math. Medicare premiums are income tested through a surcharge called the Income-Related Monthly Adjustment Amount. Most people just call it IRMA. It's based on your modified adjusted gross income from 2 years earlier, and a Roth conversion counts toward it in full. The critical detail is the shape of the thing. Tax brackets are graduated, so crossing into a higher bracket only affects the dollars above the line. But IRMA works as a cliff. Cross the threshold by $1 and you owe the entire surcharge for the full year. For 2026, a married couple stays at the standard premium up to $218,000 of modified adjusted gross income. For a single filer, that number is $109,000. Cross into the first surcharge tier, and it costs a married couple roughly $3,900 over the first year in additional premiums. The higher tiers climb from there, and at the top, the annual cost runs above $15,000 for a couple. So, 2 things follow from this. 1, if you're converting near a threshold, know exactly where the line is and where your income will land. Being a few $1,000s under is worth real money. 2, and here's the part a lot of people miss. Conversions done before age 63 never touch Medicare at all. The 2-year look-back means the income years that determine your first Medicare premium are the years you turn 63 and later. Convert at 60 or 61, and IRMA simply is not in the equation. Those are the freest conversion years you'll ever have. Now, the cliff is a cost away and not an absolute barrier. If the conversion is large and the future savings are large enough, paying the surcharge can still be the right call. The test is just math. Future tax saved minus the Medicare surcharge minus the state tax on the conversion. If the number is positive, the conversion usually earns its keep. All right, here's another thing that can break the math, and this one is new enough that a lot of people haven't really considered it. A 2025 law from the One Big Beautiful Bill created an additional deduction for taxpayers 65 and older. $6,000 per qualifying person, so $12,000 for a married couple where both spouses are 65 and older. You get it whether you itemize or you take the standard deduction. You may have heard from Trump on the campaign trail, no tax on Social Security. Well, that wasn't accomplished, but this is kind of the fruition of that. For conversion planning, this can cut both ways. The upside is that it hands you additional deduction space, which means additional room to convert at zero incremental tax costs. Across the years it's available, that's up to $48,000 of essentially free conversion capacity for a couple. The complication is that it phases out. The deduction shrinks by 6 cents for every dollar of modified adjusted gross income above the $150,000 for a married couple or $75,000 for a single filer. And it disappears entirely by $350,000 for that couple. So inside the phase-out range, your true marginal rate is about 1 1/3 percentage points higher than your bracket suggests. A couple who believes they're converting at 22% is actually paying closer to 23.5% on those dollars. That gap is small enough to overlook, but it's also large enough to change your answer if you are sizing a conversion right at one of those thresholds. One more thing about this deduction, it's technically temporary. It applies for tax years 2025 through 2028. If you're 65 or older during those years, the extra room is available now, and as it stands, it goes away after that. All right, now let's go over 3 practical mistakes that I see people make all the time. First mistake, paying the conversion tax out of the account that you're already converting. Say you convert $100,000 and withhold $22,000 for taxes. Only $78,000 actually lands in the Roth. That $22,000 left invested at 7% for 25 years would have grown to roughly $119,000 of tax-free money. Paying the tax from cash or a taxable brokerage account instead is one of the highest value decisions in this entire industry, and it's so easily overlooked by a lot of people. But it also means the size of your conversion could be limited by the cash you have available outside of the account. Second mistake, forgetting what else the conversion income touches. Conversion income can push more of your Social Security into taxable territory, up to 85% of your benefit. It can also lift long-term capital gains from the 0% rate into 15%. Both of those effects can be invisible if you only look at the bracket table. And the third mistake is ignoring your state. A conversion in a state with no income tax costs you the federal rate and nothing more, which is great. But in a high tax state, you can be adding 9 or 10 percentage points more on top of your conversion. If you're planning a move in retirement, the sequence of the move and the conversion is worth thinking through carefully. So let's talk about the cost of waiting. Let me put a number on the thing the original social media post I spoke about in the beginning was talking about. Take a couple who retires at 62 and does nothing until 68 because the conversions felt complicated and there seemed to be plenty of time. 6 years passed. $133,000 of annual capacity in the 10 and 12% brackets. That's roughly $798,000 of conversion room that no longer exists. It's not deferred, and again, you can't get those years back. Meanwhile, the traditional balance kept compounding, so the required minimum distributions waiting at 73 are larger than they would have been, and the remaining window is shorter. This is why the timing matters above all else, including the perfection of the strategy. A reasonable conversion made this year beats an optimal conversion that you never get around to do. So, what should you do with this information? And I'll give you 4 steps in order. Number 1, find your window. I would think about the year your earned income stops and the year that you plan to file for Social Security, and the year your required minimum distributions begin. The years in between are what you're working with. 2, project your income without conversions. Let's think about pension, interest, dividends, any part-time work, and that'll tell you exactly how much bracket space is actually open. 3, find your ceiling for this year. That is the lower of your target bracket and your Medicare threshold adjusted for the senior deduction phase out if it applies to you, whether you have outside cash to pay the tax. If you do not, size the conversion to what your outside cash can cover. And one timing note, conversions must be completed by December 31st to count for the current tax year. There's no April deadline the way there is for contributions. Waiting until the last week of December means acting before your final income numbers are settled. So earlier in the year gives you more control, and a second look in the fall lets you adjust. The window opens quietly. Nobody's going to send you a notice, and nothing happens in the year you fail to use it, which is exactly what makes it easy to lose. If you're somewhere between the day your paycheck stops and the day your required distributions begin, you're still standing in it right now. I'd encourage you to run the numbers for this year before the year runs out. That's all I got. I hope you found this helpful. And again, this content's for educational purposes, and it's not individualized tax or investment advice. Tax law changes and the figures cited apply to tax year 2026. So consult your tax professional or speak with a professional financial advisor about your specific situation. Again, everyone's situation is different, and there are a lot of factors to take into account. I hope this was helpful. Have a good rest of your day.